to a lot of NRIs. By nature, a lot of Indians invest in immovable properties, and in India, as it's also likely that the same is prevalent in other countries, investing in immovable property brings with itself its share of tax-related issues. And in India, we have a host of tax-related issues that go with immovable properties. So let's very quickly look at some of them. Over the next about 20-25 minutes, I'll take you through the tax-related issues, and then we will take some questions. I've tried to cover some of the commonly asked questions that come to us from NRIs all over the world. So many of you may not need to ask me the question later on, because I've tried to cover the most popular questions that come our way. First of all, if we look at what kind of income are generated from immovable properties. First of all, if your property is rented out, then you would have rental income. Even if the property is not rented out, there could be notional rent. If the property is transferred, or in a common man's language, if it is sold, then there could be capital gains. If you buy property or sell property, there would be a stamp duty implication. And even if you don't do anything, there is a passive tax for merely holding the property in the form of wealth tax. So let's look at each item one by one. If you have a house property, it can be broadly classified into three categories. One, where you have actually rented it out, it would be, for tax purposes, be called as let out property. If you have not let it out and you have kept it for your own use, it would be called in technical terms as self-occupied property. And in some cases, where it is not actually let out and it is occupied by you or your family, it could be considered as a deemed to be let out property. Rent from an immovable property which is actually or deemed to be let out is taxable under the head income from house property under the Income Tax Act, and very limited number of deductions are available from such income. So how do you go about calculating the rental income? First of all, you have to determine the gross annual value. From the gross annual value, you can reduce the municipal taxes which you pay as an owner during the previous year, or in simple language, during the financial year that you're talking about. And what you get is the balance or the net annual value. From the net annual value or NAV, certain deductions are allowable, and that will give you the taxable income from house property. And that income from house property, or the taxable income from house property, would be included in your normal computation of income, along with your other income like say interest income or capital gains, etc. And on the total income, you pay tax. So what are the deductions, as I said earlier, allowable under the head income from house property? I mentioned that there are very limited number of deductions available. So the first deduction which we saw in the earlier slide was with reference to the municipal taxes paid. So whatever, if we go back to the earlier slide, from the gross annual value, you reduce the municipal tax and you arrive at the net annual value. Then you get a standard deduction of 30% of the net annual value. So whatever, so if 100 rupees is your gross annual value and 10 rupees is the tax paid, property tax paid, then 90 rupees is the NAV, and from that you get a 30% deduction. In this case, from 90, you get a deduction of 30%, that is 27 rupees, and you are left with 63 rupees. In addition to the standard deduction, you get a further deduction of up to 2 lakh rupees if it is a self-occupied property in respect of interest on loan taken to acquire the house. So if you have taken a housing loan and you are paying interest as well as the EMIs, then out of the total amount that you repay to the lender, the interest element is a tax deductible item. If the property is rented out, then there is no limit to the amount of interest that you get as a deduction. But if it is not rented out, then the upper limit for interest deduction is only 2 lakh rupees. And other than this, there are no other deductions available. So you may keep this in mind that when you pay your monthly or quarterly maintenance bills to the society, that bill would include a certain portion towards property tax, a certain portion towards maybe sinking fund, a certain amount towards maintenance charges, lift maintenance charges, etc., etc. There could be various items in your property, in your periodic bill that you get from your society. However, for tax purposes, what is deductible is only the municipal tax portion, and thereafter nothing from the amount that you paid to the society. The periodic charges that you pay to the society in respect of maintenance, sinking fund, etc. are not tax deductible, because instead of allowing individual deductions for different items, the tax department has many years back amended the Income Tax Act and allowed only a flat 30% deduction to cover everything, whether it is repairs, whether it is sinking fund, whether it is watchman's charges or lift charges, etc., etc. So that point may be kept in mind. I mentioned earlier that you could have either a self-occupied property or a let-out property, or thirdly, a deemed to be let-out property. Now, what is deemed to be let-out? If a person has 2 houses in India, then the first, and both are, for example, both are not let out, actually let out, but are both in the possession of the owner. In that case, technically they are both self-occupied. However, for tax purposes, any one property at the option of the concerned taxpayer will be considered as deemed to be let out property. And even if he or she does not get any rent from that property, still the taxpayer will have to pay tax on the notional rent. For the purpose of calculating the notional rent, one would need to look at the market rent of a similar property in the same area, and from that notional rent, the same deductions which are otherwise available in respect of any other property, such as the property tax, such as the 30% ad hoc deduction, etc., and the interest paid on the housing loan, would be available as deductions. This was about the income, the taxation of the income that you earn from the property without selling it, meaning the income from the rental income. We now come to what happens when you sell the property. When you sell the property, you earn capital gains. And if the property has been held for more than 3 years or 36 months, then it is considered as a long-term capital asset in your hand. And in that case, the capital gains would be considered as long-term capital gains. And if the property has not been held for more than 36 months, then it will be considered as short-term capital gains. You may be aware that in India, long-term capital gains attracts a concessional tax treatment as compared to short-term capital gains. On the other hand, short-term capital gains are added to your normal income and treated like any other normal income, say interest or business income or any other income for that matter, and you would need to pay tax on that total income, which would include the short-term capital gains. So this is as far as the classification of capital gains is concerned. How do we calculate capital gains? In very simple language, first you take the sale price, whatever you've got. From that, you reduced the cost of acquisition or cost of improvement, as the case may be. But before you do that, generally when you sell a property, you also incur certain expenses like legal fees paid to the lawyer for drafting the agreement, or brokerage paid to the estate agent who brokers the deal, or you may pay some transfer stamp, transfer duty or transfer fees to the society. You may also bear a part of the transfer, the stamp duty that is paid on the transfer, etc. So all the expenses which are incurred in order to sell the property are tax deductible and are reduced from the sale consideration. And from the net sale consideration, you reduce the cost of acquisition and the cost of improvement of the property, if any. That will give you the capital gains. If it is long-term capital gains, then instead of merely reducing the cost of acquisition or cost of improvement, you have to reduce the indexed cost of acquisition or indexed cost of improvement. And thereby you get the long-term capital gains. If it is, as I said earlier, short-term capital gains, then it is added to the normal income, and whatever is your normal slab rate, you would need to pay tax at that rate. If it is long-term capital gains, then there is a concessional tax rate of 20% plus the applicable surcharge and the education cess of 3%. There are certain cases where we have heard a lot of NRIs are covered by these kind of cases, where either the NRI has got the property by way of a gift from some relative or somebody else, or where the property has been inherited. In both these cases, what will happen is that since the NRI who is now holding the property would not have incurred any cost of acquisition, the cost will not be nil or zero, but the cost will be the cost in the hands of the original owner. So if you as an NRI have been gifted a property, then in your hands the cost will be considered as the cost in the hands of the person who has gifted you the property. And if you have inherited the property from your father or mother or any other relative, then the cost in that your father or mother or that relative had incurred to acquire the property would be considered as your cost. And similarly, the date of purchase would also in your hands be not the date on which you were gifted the property or the date on which you inherited the property, but the date on which the original owner acquired the property. So for example, you inherited a property in the year 2007-8, then and you have now sold the property in the year 2014-15. Then for the purpose of calculating the capital gains, and this is more relevant in the context of the indexation of the cost, the index will not be applied with reference to the year 2007-8, which is the year in which you have acquired the property by way of inheritance or even by way of gift, but you have to look at the financial year in which the earlier owner had acquired the property. So in this example, if your father or mother or relative from whom you have inherited the gift or who has gifted you the property, that person suppose had bought the property in the year 2001-2, then when you sell the property, your date of acquisition or the year of acquisition would be considered as 2001-2 and not 2007-8 in the example that we talked about. So this is important because the indexation goes back to the year of acquisition, and therefore in this case the year of, the index will apply from year 2001-2 and not 2007-8. If you have long-term capital gains, then it is not necessary that you are forced to pay the tax at 20% on the capital gains. There are ways of saving tax on the long-term capital gains. There are two sections available for you. One is section 54, where if you purchase a residential house in India within 1 year before or 2 years after the date on which you transfer your existing house, or if you construct a residential house in India within 3 years of the date of transfer or date of sale of your existing house. So for example, if an NRI sells his residential house in India today, which is 7th October 2014, the long-term capital gains will be earned in the financial year 2014-15. If you want to save the tax on that by investing in another residential house in India, then the time period that applies to you is, in case of purchase of a new house, 1 year before 7th October, that is 8th October 2013 up to 7th October 2014, or 2 years after 7th October 2014, that is up to 6th October 2016. Within this period, you can purchase a residential house property. It does not necessarily have to be a brand new house. You can obviously buy a second-hand house also, but you have this time limit applicable if you are going to purchase a house. In the alternative, if you want to construct your own house, you buy a piece of land and you want to construct your house, then the time limit is 3 years from 7th October 2014 in our example. So you have up to 6th October 2017 to construct your own new residential house property. So these are the time limits available under section 54 if you want to invest in the new house property and save on the long-term capital gains tax. Of course, as I said earlier, if the property that you have sold is not a long-term asset but a short-term asset, then this particular exemption is not available to you. Similarly, on the other hand, or in addition to the exemption under section 54, you can also avail of the exemption under section 54 EC by investing in capital gains bonds up to rupees 50 lakhs within 6 months from the date of sale of your house. So in the same example that I gave earlier, if you have sold your house today, that is 7th October 2014, then within 6 months, that is within or before 6th April, you can invest in the capital gains bonds. These capital gains bonds are issued by 2 agencies in India. One is the National Highway Authority of India and the other is the Rural Electrification Corporation of India Limited, NHAI and REC. Both these entities on a regular basis issue these capital gains bonds, and you can subscribe to them. However, the upper limit is 50 lakhs. You cannot invest more than that, and you will not get, even if you are somehow able to invest, you will not get the exemption in excess of 50 lakhs. So these points may be kept in mind, as if you are planning to buy a new house in place of your existing house, under section 54, the exemption is available only if the residential house is bought in India. This particular aspect, that is the house having mandatorily to be bought in India, has been brought into the Income Tax Act by the new Modi government in the last budget that we had in the month of July. Prior to that, a person could have invested outside India also. However, going forward, the investment has to be made only in a house located in India. If you are buying a house as an NRI, you also need to be aware that if the purchase price is more than 50 lakhs of Indian rupees, and you are buying it from a resident, then you need to deduct tax at source or withhold tax at source at the rate of 1% of the total purchase price. So, for example, if you are buying a property worth 7.5 million rupees, that is 75 lakh rupees, then, and if the seller is a resident Indian, then you need to deduct 1% of 7.5 million, that is rupees 75,000 from the purchase price. In case the seller does not have a PAN, then the buyer has to deduct tax at 20%. That tax which you deduct has to be paid to the Government of India. You need to fill up a form called Form 26QB, and you, after paying the TDS to the Government of India, you also need to issue a TDS certificate to the seller. So these are additional responsibilities that you as a buyer of a property need to comply with if you are buying a property worth more than 50 lakhs in India. And you need to be very careful about this, because TDS is an extremely problematic section in India, and for the smallest of defaults in the TDS provisions, there are lots of penal provisions that affect the defaulting person. So please take care of this. Then we have a passive tax, as I mentioned earlier, that even if you don't earn any income from house property, even if you don't sell the property, you may still need to pay some tax just for holding the property. And that is called wealth tax. And we have seen in the past that a lot of NRIs have defaulted on the wealth tax provisions. So kindly pay attention to this particular slide, as you may be defaulting on the wealth tax provisions purely because of the ignorance of law. If you first of all, you have to understand that wealth tax is payable only on a few specified assets, and a house property is one of those specified assets. Land is also, urban land is also in one of the specified assets on which wealth tax is payable. Wealth tax is payable if the value of all the specified assets that you own as on 31st March of every year exceeds 30 lakhs or 3 million rupees. So if you have jewelry, if you have an urban plot of land, if you have a motor car in India, etc., and the total value of all these assets exceeds 3 million rupees or 30 lakh rupees as on 31st March, then on whatever is in excess of 30 lakhs, you need to pay wealth tax at the rate of 1%. If you have only one self-occupied house property, then there is no wealth tax payable on that property. If you have more than one property, then any one property will be exempt, and on the other property you will need to pay wealth tax. Of course, the value needs to exceed 30 lakhs, but that property would be covered by wealth tax. There are two kinds of properties which are excluded from the purview of wealth tax. One is a property which is let out for more than 300 days in a year, and the other is a property which is used for carrying out business. I presume that in case of NRIs, the second category may not be applicable, as you may not be in India to do a business in your property. But if you have a property which is let out for more than 300 days in a year, then even if the value is 30 crores or whatever, you don't need to pay wealth tax on it. The wealth tax return needs to be filed simultaneously with your income tax return. So the due date which is applicable to your income tax return is also applicable to your wealth tax return if you are covered by wealth tax. Apart from all the income taxes and the wealth tax that is payable, there is also the issue of stamp duty. Stamp duty is charged by various state governments based on the ready reckoner values. Generally, it is payable by the buyer, but it would depend on the contractual arrangement between the buyer and the seller. For tax purposes, there is a very detrimental provision in the Income Tax Act which says that if the stamp duty value exceeds the agreement value, then for capital gains purposes, the amount that is taken into consideration is not your agreement sale price, but the stamp duty value. To illustrate, if you have sold a property as per agreement for say 75 lakhs, and the stamp duty value, that is the value on which you pay the stamp duty to the stamp authorities, is say 90 lakhs, then for capital gains purposes, your sale consideration will be considered as 90 lakhs and not 75 lakhs, which is what you may have actually received. So you need to be very careful about this, and therefore the stamp duty assessment should also be given a lot of importance and not merely treated as simply as an additional cost. It is an additional cost, but it has income tax implications which you may kindly keep in mind. As far as the repatriation of funds on the sale of property is concerned, that is of great importance to all NRIs, that when you sell a house property, can we take the money out of India or not? In the normal course, sale proceeds of an immovable property have to be credited to an NRO account only. Remittance up to $1 million per financial year is freely permissible from the NRO account. In case of sale of residential house property, the AD, that is the authorized dealer, or in simple language the banker, may allow repatriation of sale proceeds provided the following conditions are fulfilled. One, first of all, that the property was acquired in accordance with law. The repatriation amount does not exceed the cost of acquisition. And in case of resident property, the repatriation is restricted to not more than 2 such properties. At the same time, current income can be freely remitted from NRO account, and therefore the surplus that you get over and above your cost can be classified as current income, and therefore it can be freely repatriated. So to put it in simple language, up to $1 million, if you have the sale price of a house property in India, you can freely repatriate it, subject of course to the payment of the income tax in India. At the time of repatriation, your banker will obviously ask for certain documentation. He will also ask for a certificate from your chartered accountant, which certificate will tell the banker that whatever was the tax payable on that 1 million or whatever is the amount that is being repatriated has been paid by you to the credit of the Indian Income Tax Department. Once you provide the documentation, up to 1 million USD can be repatriated freely without any problems. So friends, this is what I had to say as far as the presentation is concerned, and now we can take the questions, if any, from the audience. Thank you very much.
Hello. Thank you, Mr. Patel. Thank you for giving us a very good presentation, which is really helpful.